What's going on? Steve here with IBC Global. In today's video, we are going to answer the question, can I use my IRA to make a lump sum deposit into a whole life insurance policy? This is a question we had received from someone on YouTube recently. So let's get on into it and have some fun talking about cash value life insurance. So with this question, can I use my traditional IRA to make a lump sum deposit into a whole life insurance policy? Basically, what people want to do is take money that they have accumulated during the majority of their lives, money in a qualified account, an IRA, a 401k is very, very similar. We want to take money that we've built up and move it into a whole life insurance policy. Here is often the reason why, or some reasons why we see people attracted to this strategy. When you look at money you have in an IRA, that money is taxable to you when you pull it out. Meaning an IRA is a qualified account. The account value grows tax deferred, meaning as it grows, you do not need to pay any tax on it. However, when you distribute the money, when you take anything out and it goes to you, to your bank account, you're then taxed on it. And you're taxed on it as ordinary income. So IRA money is taxable to you when you pull it out. And then also, if you're leaving it to the next generation, it's also taxable to your kids or to the next generation. So when that money comes out, it is going to be taxed in most scenarios, almost every scenario. So what people are interested in is taking money that they have in an IRA, moving it to a whole life insurance policy. And here's why. First, we've got the cash value. And then second, we've got the death benefit. Why one is interested in the cash value? One, because it's safe. The money continues to appreciate over time, regardless of what occurs in the stock market or the economy. So with an IRA, if I have money in stocks, bonds, more risky investments, and I'm looking for something safe, cash value life insurance provides that. That is one appeal when we look at the safety, especially for people in retirement. We see that a lot. The next reason why is the liquidity. It's very easy to access the cash value. And if you do everything right with respect to accessing the cash value, you can access it tax-free. So benefits there with respect to the cash value. Those are the reasons why people are attracted to moving money they have in qualified funds over to a whole life insurance policy. When we look at the death benefit, that is paid income tax-free to our beneficiaries. Whether it is our spouse or if it's our kids, the next generation, when the death benefit's paid out, it's paid out income tax-free. This is a much more effective way of leaving money to the next generation than leaving money through an IRA. So those are a couple reasons as to why people are interested in this strategy. For the individual that asked this question, he's 70 years old. So real quick, what that means is he's over the age of 59 and a half. If you don't know what that means, here's what it means. When you're looking at a qualified account like an IRA or a 401k, with those accounts, if you touch the money prior to age 59 and a half, in most circumstances, you're going to have to pay an additional 10% penalty tax. This is on top of what you would pay in ordinary income tax. So these accounts are designed for retirement. That's the purpose of these types of accounts. So we're discouraged to access the money before then. So this individual does not have to worry about that. Now, IRA money, again, is taxable as income. Taxable as income, not capital gains. And another thing I like to add here is that anything you pull from an IRA is taxable as income on top of any other income that you have. So what that means is if you earn a total of $100,000, that's your income for the year, and you pull another $100,000 from an IRA, what's your total taxable income? Well, before, from other sources, it was $100,000. You took another $100,000 from the IRA, 100 plus 100 is 200. That is now your taxable income for the year. So that is important to be aware of. Most people know that. I find that it's valuable just to mention it to help us realize, okay, if I take out X amount of dollars, I have to account not only for what I pull out, but that's tacked on top of my ordinary income. So my tax bill might be a little bit high. So what we're going to look at in this example is an IRA amount of $1 million, a nice round number, We'll change it too. We'll make it lower. We can make it whatever we'd like. We're going to pull up one of our calculators. But we're going to look at three options here, or three popular options. Option one is what he asked for, a lump sum. So if he takes the full $1 million out of the IRA and then moves it into a life insurance policy, what is he taxed on? He would be taxed on the full $1 million for that year. So if you just cash it out and say, hey, give me the full amount, what will happen in almost every case is you'll have to pay income tax on the full amount that you cash out. What we cannot do is transfer money from an IRA directly to a life insurance policy and avoid tax. That's not possible. That question does come up sometimes. We can't do that because an IRA is considered a qualified account, whereas a life insurance policy is considered a non-qualified asset. So you've got two different categories there. But the $1 million, if we just took a lump sum out, it would be taxable. So if he has to pay 40% tax on that, he would be left over with a net of $600,000. Then he would have that money to work with to move over into a whole life insurance policy. That's you. Is it appealing? Maybe, maybe not. What's going to be hard for a lot of people is the $400,000 hit that we've got to pay in taxes. But from the IRS's perspective, what they would say is all of these years, when you built it up to $1 million, you didn't have to pay any tax. It grew tax deferred. And if you funded it with pre-tax dollars, like a 401k, that was money that you didn't have to pay any income tax on the time either, meaning the money that you contribute, if you deducted it from your income, you got a tax break there. So the tax break is often upfront with qualified accounts. On the back end, we're going to pay taxes. So if this is not appealing to you, which to many people it's not, an alternate strategy is to spread it out over a few years. Let's say we spread it out not over a few years, but over 5 years at $200,000 per year. Now the gross amount might end up being a little bit higher than that because while it is still in the IRA, it's likely earning interest, it's appreciating. So here we're assuming we just get the clean $1 million out with no appreciation or no interest. But if it's earning interest, the amount you would receive would be a little bit higher. So in this case, what would happen to you from a taxable standpoint? Well, each year, $200,000 would be considered part of your taxable income. So at $200K per year, we want to see how much are you going to pay in taxes, and we can compare that to the lump sum amount as well. And we would just give quick ballpark amounts whenever we're looking at a strategy like this or any strategy that involves qualified accounts. We always want to make sure that you're consulting with a CPA, your accountant. We can work with them as well, just because we are not tax professionals and none of this is tax advice either. Just full disclosure there. So that is option B, where we can spread it out over a few years or whatever number of years makes the most sense. Or C, you've got autopilot, which is the same thing as option B, but it makes life a little bit easier. So with option B, the $200K per year, if that's the number, we're doing that manually. Every year, we are requesting $200,000 from our IRA, and then we're moving the amount we want to move into the life insurance policy. We're doing it manually. If we like the autopilot approach, how this works is we would take the full $1 million from the IRA. Let's do it this way. And we would transfer that to an annuity. And this would be tax-free transfer or rollover. So it's going to be transferred to annuity. And then what happens with the autopilot piece is the annuity will feed the life insurance policy each year. So that'll be $200K per year, or it'll be more than that because you will be earning interest while it's with the annuity. This is a nice strategy if we like option B, but we don't like the hands-on approach. We just want it streamlined. It makes it much easier that way. So option C allows for that. How it works from a taxation standpoint is when you transfer the $1 million to the annuity, that is often not taxed. However, each year that the $200,000 or whatever the dollar amount is comes out of the annuity, even if you have it set to go straight to your life insurance policy and that builds cash value, you're still taxed as income. So say 200K goes from the annuity to the life insurance policy, you would still receive, call it a 1099 for the $200,000 personally. So we want to make sure we account for that we've got the taxes set aside to pay that, or maybe we are taking the 200K, we're funding the policy with 100 or 150 and setting the rest aside for taxes. We've got to make sure we discuss that and have a plan there because we don't want any surprise tax bills. So from a conceptual standpoint, that's how this works. That's how we would answer the question. The answer to the question is yes, you can do this, but there are some things you might want to be aware of from a taxation standpoint. So if we want to get fancy with this, we would do this. So here is a calculator. It's pretty straightforward. I know we've got several columns here, but I'll walk through it one at a time. We'll begin with the balance, and this could be a 401k or IRA balance. If we've got $1 million up top, we would plug in $1 million. Then we've got the interest rate. So the interest rate here assumes whatever the appreciation is. Here we've got 5%. If you feel that 5% might be a little bit aggressive, if you say, hey, that's a bit high in retirement, I think I'm going to look at a 4% return here, then we would do that. And notice that you're compounding here. So 4% of $1 million is $40,000. Okay, that's great. 4% of $1,040,000 is what? $41,600. So this is compounding over time. So we've got the balance, then the interest rate, we can adjust that. Then we've got the distribution. And the distribution in purple is the gross dollar amount. So if you said, let's pull out $200,000 per year. First off, how much could I pull out at that dollar amount? 4 years. What do you have left the last year? 138 and change. Power of compound interest, right? You're able to get your million out plus another $138,000 and change. However, keep in mind, these are gross distributions here in column E. When we scroll our eyes to the right and we look at light red, what do we see? Our tax rate. Okay. So the tax rate we can change. Right now we've got it at 30%. If we're taking 200K out and we're already living off of 2 or 250, our tax rate could be higher. So we can adjust that obviously, which will have an impact on how much taxes are due. Let's go 30% for this example, what we had originally. So we can change the tax rate. Tax due is pretty straightforward. At a 30% tax rate, all we're doing is taking 30% of $200,000, which is $60,000, which leaves you with a net of $140,000. So this is the net amount you receive after you pay taxes. If you want to look at this, what's the total amount I got? Just about 800K. And where you could really have fun with this, what happens if interest rate's a little bit higher? How much would you have gotten? All right, now you're at 825 and change. Pretty cool how that works, right? The interest rate might vary year to year. There's a lot of things that go into this. And this is a very simple overview of how we would look, what we would look at with a strategy like this. Again, we would make sure that we're involving a tax professional and being thorough in this. Sometimes we'll work with individuals, we'll go through this, and then we'll recommend that they run it by their CPA. They'll do that, then they'll come back with questions. My point is we do want to make sure that a professional is involved that knows what your taxable income is and will have a lot more transparency around you taking $200,000 or whatever the dollar amount is, and how it will impact your income tax bracket for that particular year. But with all of that said, in a strategy like this, for the gentleman that wanted to move his IRA money over to a policy, that's what he wanted to do because he had other funds he was living off of, and he was interested in the cash value benefits, also the death benefit for the next generation. Here's what we would look at in a case like this. If he wants to pay the tax each year, he's netting the account, so he takes out $200, knows he'll have $60,000 due. He'll just pay that from the $200K, and then we'll fund a policy with the net amount, $140 per year. So that gets a total of $800,000 into the policy, which will easily give him a death benefit much higher than $1 million, even starting at age 70. And the cash value will exceed $1 million in time as well. Funding $800K over 6 years, you see $1 million in cash value, probably beyond year 10 when you look at it, but a death benefit that's much higher than that as well. That's where we would really analyze the policy and go through how to maximize the cash value, which we cover in almost every other video we have, so we're not going to do that today. Anyway, that just provides, again, an overview of what we would look at in his particular situation. So I hope you enjoyed this video. Please let us know if you did in the comments below. If you enjoyed it, please hit the like button and subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.